Welcome to BD Daily Finance News Podcast, daily insights on markets, economy, and investing. Today is 2025, December 15th, and the theme is simple. Markets are arguing about rates, liquidity, and who gets stuck holding risk when the big players change their minds.
I love when markets argue. It's like a group chat where everyone's typing in all caps, but the only emoji is a red candlestick.
3 stories. First, the U.S. Treasury market debate over the Fed's 2026 rate cut path is heating up as key economic data approaches. Second, Japan's Bank of Japan is said to start selling its ETF holdings as soon as January, an exit expected to take decades. Third, China's retail sales growth sharply missed estimates in November, deepening consumption worries.
So we've got America debating how many rate cuts, Japan slowly unhoarding stocks, and China's shoppers ghosting them all. Cool. My index funds are sweating.
Story 1. A bond market debate is brewing over how far the Federal Reserve will cut rates in 2026. The setup is straightforward. Traders and economists are staring at upcoming data releases and trying to price the endpoint for policy rates.
When you say endpoint, I picture the Fed like a tired parent. This is our final rate cut. Do not ask again. And then the economy throws a tantrum in aisle 5.
Here's the simple finance behind it. Bond prices move on expectations. If investors think rates will be lower in the future, longer-term Treasury yields can fall today because you're locking in returns over time. If they think cuts won't happen or will be smaller, yields can rise.
So it's basically like buying concert tickets. If you think the artist is about to get less popular, you wait for cheaper tickets. If you think they're about to go viral, you buy now before prices jump.
Exactly. And why it matters for normal people? This debate filters into mortgage rates, auto loans, business borrowing, and the valuation math for stocks, especially growth stocks. When yields rise, future corporate profits get discounted more heavily, and high multiple stocks can wobble.
If the bond market gets cranky, this company won't make money until 2032 stocks start acting like they just saw a ghost.
Actionable takeaway. Don't anchor your whole plan to a specific number of cuts. Instead, stress test your budget and portfolio for 2 scenarios. Rates stay higher for longer, or cuts arrive faster. If you carry variable rate debt, prioritize paying it down. That's a guaranteed return equal to your interest rate.
I love stress test. Nothing says financial wellness like voluntarily imagining a worse timeline, like a Marvel movie, but it's just my credit card APR.
Story 2. The Bank of Japan is said to start selling its ETF holdings as soon as January. Remember, the BOJ accumulated a large pile of equity ETFs over years as part of extraordinary stimulus. Now the conversation is about how to unwind without spooking markets.
Central bank selling stocks feels like your friend who swore they'd never sell their vintage sneakers, and then they list them online at 2 a.m. like, no lowballs, I know what I have.
The simple version. When a huge buyer becomes a seller, even slowly, it changes the supply and demand balance. If the BOJ drips shares into the market over time, that's a steady source of supply. The report suggests the process could take decades, meaning they're aiming for minimal disruption, not a fire sale.
Decades is wild. That's not a plan, that's a family heirloom. Kids, when I'm gone, please continue selling these ETFs responsibly.
Why it matters. Japan has been a key piece of global liquidity conditions. If the BOJ is normalizing, reducing extraordinary market support, that can increase volatility in Japanese equities and potentially affect global risk sentiment. For diversified investors, it's a reminder that policy regimes change and central bank put assumptions can fade.
So the training wheels come off and everyone suddenly remembers bikes can wobble. Got it.
Story 3. China's retail sales growth sharply missed estimates in November, and reports also point to investment weakness, adding to concerns about consumption and the property-linked drag. Markets watch this because China is a major engine for global demand in commodities, manufacturing supply chains, and multinational revenues.
When China sneezes, somebody's earnings call gets a fever, and the CFO is like, it was currency headwinds, while quietly sweating into a spreadsheet.
The simple finance behind it, weaker consumption can mean lower pricing power for companies selling into China and less demand for inputs like energy and industrial metals. That can ripple into commodity prices, emerging market performance, and the revenue outlook for global brands.
So if I own a broad global index fund, I'm basically holding a passport that still gets stamped by China's consumer mood.
Quick wrap with 3 practical moves. 1. If your emergency fund is thin, build it. Rate uncertainty punishes people who have to borrow on bad timing. 2. Keep your bond exposure aligned with your time horizon. Don't chase long duration just because you want cuts to happen. 3. Diversify by geography and sector, but know what you own. China sensitivity shows up in more places than you think.
And my practical move is stop doom refreshing the markets like it's a reality show. Set rules, automate what you can, and let your portfolio be boring so your life can be interesting.
If this helped, subscribe and share the episode. Tomorrow, we'll be back with the next set of signals, and we'll keep translating the Wall Street group chat into plain English.
And if you're listening while commuting, eyes on the road, not on the yield curve. See you next time.